Hello, welcome to another episode of Triathlon Partners TV. This is Ira Coiner, the original IRA. Today's topic that we're going to discuss, structured notes, but a specific type called income notes. You all know I really like structured notes. I think they're a great way to complement your portfolio. And this is a different type of note that we haven't spoken about. They create income. And how do they do that? Well, first, let's talk about who this might be appropriate for. If you're one of those investors looking at the market, looking at all-time highs, thinking, oh, I don't want to put new money in the market. I might actually want to take money out of the market and I want to save it for that 20% pullback. Now, what are you going to do during that 20% pullback? Probably still have some money lying in the market because you don't want to sell everything out because you don't want to incur a tax liability. So what you're going to do is you're going to take a paper loss during this time, and your money's not working hard for you. So we have an answer. Let's get your money working hard for you. And these income notes are a fantastic, fantastic product, tremendous product. So first of all, these notes have a maximum time period. The notes could cancel early, and that's to your benefit, right? So let's say the note has a 3-year time period. The note will expire or mature in 3 years. Now, the note is based on the performance, the principal of the note is based on the performance of the underlying security. Security is very likely an index like the S&P 500, the NASDAQ 100, the Russell 2000, or even yet a combination of those indexes where that principal's payout is dependent upon the worst performer. We've gone over the worst performer concept beforehand. It's really great to get better leverage on your returns. So these notes have two levels that are important to know. One, a protection level so that you get your principal back 100% if the worst performing or the index that it's based on is greater than a certain amount, meaning if the market's down 30%, you still get 100% of your money back. It doesn't exist in things that aren't structured notes. And number two, there's a coupon level you get. So that means you get income. So if the original index is greater than 80% of its original value or 70% of its original value, you still get the coupon. So the underlier could be lower, but you still get that coupon. You're still earning money, right? You're not getting that in other things. You might get it in a dividend stock, but your dividend stocks are earning 3 to 4% maximum at best. These earn a lot more. Okay, so how does this thing pay? First of all, there's a certain period where these notes can't be called. They're live. Typically, maybe the first 6 months, maybe the first year. So if the underlying index is greater than that coupon floor, greater than that 80 or 70% original value, you get that coupon. And these coupons vary from 8 to 12%. It depends what it's on, depends the underlying index, depends what level that coupon threshold is, as well as that overall protection. Now, what's great about these notes is if the underlying index or the worst of the underlying index is positive, the note gets called, meaning you get 100% of your principal back. You get all the interest that you're owed back. And that way, the market's now positive and you're able to invest in a market that's going up. All right. So what advantages does this have in terms of the actual rate? Well, these rates again said range between 8 and 12%, could be quite lucrative, especially if you have in a non-taxable account like a Roth IRA or a 401k or a rollover IRA. Now, the difference between that, the 8 to 12%, is when we look at today's or yesterday's close in US Treasuries, for 3 years, you're earning 4.36%. For 5 years, 4.4%. So you're going to be earning 3.5 to 7.5% higher per year in these notes, right? It's a natural hedge against what you have in your market, because if you're a long-term believer that the stock market's going up, you have to accept a 10, 20, or 30% decline every once in a while, but you're still earning money and you're earning significant money, right? So these are very, very important. And these are in indexes. They're not in high yielding junk debt that might have appealable yields of 6%, 7%. These are not junk companies, they're the broad market indexes. So I hope you found this a little bit educational. I know a lot of you never heard of the income producing notes, but this is something that I want you to know about. This is something we really get our clients into and excited about because they're better yields than what's out there, and you get that nice buffer. So if you're long-term bull on the stock market, if you think the stock markets might retrace and you have money on the side sitting in that checking account, sitting in that low bank account at your broker, you're really missing out on several fantastic notes out there that you're not locked in long term. This is not a CD that you're locked into for 3 to 5 years because the market could go back up in 3 to 5 years beforehand, and you're going to miss out. As soon as the callable date, which could be every month, as long as it's positive, you get your money back and you get that minimum return, which is well above what's out there in the market. Okay, thanks a lot. Again, this is Ira Coiner, the original IRA, speaking on this episode of Triathlon Partners TV. Please, you see our numbers here. Give us a call. Reach out to us. We're happy to help you find the investments that are right for your financial objectives. Please, we love the thumbs up, right? We love our supporters and subscribers. Leave some comments. It really helps us out with our sponsors. All right, everyone, have a blessed day. Please read the disclaimers at the bottom of the video description. Take care.